What happens when you leave a $20 billion Rocketship startup to buy your first small business? Chandra thought his first electrical contracting deal was a no-brainer, 1x EBITDA, 80% seller financing. Instead, he lost $300,000 his first year. From reluctant sellers hiding QuickBooks files to discovering fraud after closing, his story is packed with lessons every buyer needs before signing the dotted line. Since then, he's built a portfolio spanning electrical services, underground construction, and fiber splicing, growing revenue into the tens of millions. In this episode, Chandra shares the deals that worked, the one that nearly broke him, and the number one thing he looks for now before buying any business.
When you're a searcher and you're trying to find your first deal, that's the way to go, right? Biz buy
Yeah.
sell, US businesses for sale, all those publicly facing sites. The deal was $500,000. It advertised for above $500,000 of EBITDA. How wrong we were. After the deal was done, we ended up losing about $300,000. The seller was really reluctant to give us QuickBooks data. So he would just give us reports. He wouldn't give us the actual QuickBooks file. And his continued pushback was, well, I've got a bunch of personal things in there that you don't need to see. We looked at it like, well, this is just probably another guy who's trying to avoid taxes by putting a lot of stuff through his business. It's not the end of the world. And then when we did our little bit more due diligence on the seller, he had a lot of IRS issues. Didn't get too far into it. We only found out kind of afterwards, but he had built a cabin and marked everything as a business expense. He built himself a house. He built himself all these things and just said, oh, they're all business expenses. So that is a big red flag. I mean, looking at businesses now, we always look at the character of the seller. Whereas before, it was more like, well, we could fix it. As long as the business makes money, then we don't have to deal with these character issues moving forward. Historically, my background was in technology. So I worked for some of the big guys like Oracle, and then I joined a really small startup. And that startup happened to go crazy. It was called Coupa Software. And went from a company valued at $50 million, so not really small, but mid-tier, to when I left, it was $20 billion. So it was a huge rocket ship. But that taught me a lot along the way around scaling and a few other things around company culture, which are super important, and I'll touch on that later. During this time, I also started acquiring businesses. So in 2018, I had my first partnership with one other person. His name is Colin Anderson. He and I decided, we've been friends for so long, we decided, let's just start buying businesses. Let's do what we can to build the portfolio. It'll be easy, is kind of the thought process. So we went on biz buy sell like everyone does, and we ultimately came across an electrical contractor. We had no idea what we were doing, but this electrical contractor was advertised at basically 1x EBITDA, and we thought, this is a no-brainer. We're going to get our money back in 1 year. I'm so excited. So we went through and we ended up buying this company, Go for Electrical Construction. Some hiccups along the way with the seller, and I'll get into that as we jump into the conversation. But it was the jumping off point to start really going after companies and starting to get this idea of like, hey, let's build our own Berkshire Hathaway, or let's build something worthwhile. So then that was in the beginning of 2018. Fast forward to 2020, we closed on another electrical contractor in January, closed on two more acquisitions in 2020, underground construction and fiber splicing. And then we did acquire some real estate in 2021 as part of the holding company. But then fast forward to 2022, we acquired a trailer manufacturing company, which was a disaster. And no doubt we're going to jump into that as well.
Yeah.
And in 2023, we ended up selling that trailer manufacturing company because it didn't quite fit the holding company after spending just a ton of time and money fixing it. Then in 2024, we closed on our latest acquisition, which was another electrical construction company. That was more home services based.
That's
So yeah,
awesome.
we've done a number of acquisitions that we still hold in the platform, and along the way we did actually do another partial buy So we did a stock sale to invest in another company, and we ended up selling that off as well. So, but yeah,
Nice.
so far it's been a lot of fun.
That's awesome. So let's start with that first one. So it's an was it a electrical construction company or just pure electrical business, electrical services?
It was construction. It was 100%, big projects. I think the specialty was more around multifamily, hotel builds, things along those lines.
Okay. And were they doing the underground construction or is it just install? So they were doing the install electrical side
Yeah,
on
so it
the
was
commercial.
more the latter. And if there was any underground component, it was always subcontracted out.
Got it. Okay.
So
And so
yeah,
you said one time EBITDA, how did you find that deal?
it was just biz buy sell.
Biz by stuff.
Like everything. That's when you're a searcher and you're trying to find your first deal, that's the way to go, right? Biz
It
buy
is.
sell, US businesses for sale, all those publicly facing sites.
What was
And
the go ahead, sorry.
the deal was $500,000. It advertised for above $500,000 of EBITDA. How wrong we were. Uh, First year's performance, we ended up, after the deal was done, we ended up losing about $300,000.
So tell me a little bit about that. Did you finance or was it cash?
So this was 100% seller note,
100%
and
seller.
oh, let me
So
take
this
that
is like
back.
the per
We
hold on. So this is like the
All of the
perfect
finance
deal.
part was seller note. We did
Okay.
put down, I think, $160,000. So the
Okay.
remaining portion, 340, was seller note.
It's the perfect deal for a brand
Yeah,
new first buyer.
yeah,
One one multiple EBITDA and 80% seller finance or 75% seller financing. Okay. Um,
yeah.
yeah, so you did your due diligence. What did you
No.
miss? Oh, you no due diligence.
I mean, we did to an extent, but I think what we have learned through the last several years is that we need to have a good team around us to, one, to help us with the due diligence, but also to not look at the data with rose-colored glasses.
Sure.
So, when we took the business, or when we were going through the process of researching the company, we found a few things. I mean, one, the seller was, really reluctant to give us QuickBooks data. So he would just give us reports. He wouldn't give us the actual QuickBooks file. And his
Mhm.
continued uh, pushback was, well, I've got a bunch of personal things in there that you don't need to see. Okay. All right. And then, we looked at it like, well, this is just probably another guy who's trying to avoid taxes by putting a lot of stuff through his business. It's not the end of the world. And then, when we did our little bit more due diligence on the seller, he had a lot of IRS issues. So didn't get too far into it. We only found out kind of afterwards, but he had a lot of um I think it was claims from the IRS. We found out afterwards that he had built a cabin and marked everything as a business expense. So he built himself a house, he built himself all these things and just said, "Oh, they're all business expenses." So that is a big red flag. I
Yeah.
mean, looking at businesses now,
Yeah.
we always look at the character of the seller. Um, Whereas before it was more like, well, we could fix it. As long as the business makes money, then we don't have to deal with these character issues moving forward. So
Yeah. It
that was
always
some of the
comes
other
back
stuff.
and bites you. I
It
had
does.
an interview with the seller where on the call she tells us we were pushing her a little bit with the due diligence. This is where hiring the quality of earnings person, and she brings her accountant, and we're asking like for more details on the ad backs, and then she says, "Oh, I don't have anything on those." It's like, well, how did you come up with the number? Well, I just made it up and and then she talks to the accountant and then we said something about like, well, it's okay, give us the bank statements and stuff, we'll redo the we'll do the whole uh book. She didn't have any QuickBooks, nothing. And then she says, no, I don't want to do that because that's part of the IRS uh letters I'm receiving. And then I'm like,
Okay.
okay, I think we're gonna need to end this conversation right now. There's no point
Yeah.
of moving forward. But you learn, because I think in your case, in the beginning, that rookie mistake, your first deal, the deal is so good. The seller is a one time like this. It's still that lure of this 1x multiple plus 80% seller finance or 75% seller finance. Those two combinations you think are going to de-risk your deal.
Exactly. And, you know, this is, you know, I look back at that deal and I think, hey, we've come such a far way, but that
Yeah.
deal did get us in the game.
Yes.
So we sometimes romanticize buying businesses, and that's where we were, right? That's where we were looking at everything with rose-colored glasses. And I can point to all of the errors that we made, but once again, it just comes back to it got us in the game.
Yes.
You know, we jumped head first. We have a little bit of brain damage from it, but now we can take that on to the next deal.
And it's great tuition to learn everything that you've learned. So so your first year you lost 350, and then and that's, we said 2019, right?
And that was 18.
18. Okay.
Yep.
So and then the following year, so
The following
19.
year we made, I want to say, about $400,000. So we were
Okay.
slightly, when you think of the 2 years, we were slightly ahead.
Okay. And then you
The
didn't
reason,
start. Go ahead. Sorry.
oh no, I was gonna say the reason for the big loss, and this is something that any acquirer should know about if they're looking at buying a construction business, is primarily how far the group has built already on a project. So we took over all these projects mid-year or mid-project, and the seller had forward billed a lot of things. So he took a lot of the profit. He took a lot of the profit from the projects themselves, but also forward billed. So then we were working at essentially a loss. So it's just something to take forward. We didn't pay attention to it as closely. Once again, it was the allure of this is 1x. Well, even if it's 0.75 x, it should be fine, right?
Yes.
So that was the thought process.
That makes sense. So now you waited till year 3 to do the next acquisition, correct? Like in
So
18, 19,
yes,
20, 2020.
yeah. So we did. Yep, we did the next acquisition in January of 2020.
Okay.
That was another electrical construction business. So the big mistakes that we made, and I'll talk about the mistakes throughout the course of the journey, but what we did was when we made that acquisition, we decided to bring the seller from the first business. He had become an employee. We decided to bring him in as a partner because he was the master electrician. So he was the license holder. And we thought, you know, we'll just lock him up. We don't have to worry about the license moving forward. And since Colin and I are very well aligned, if there are issues that require, you know, voting or anything like that, we have 2/3 the vote. It should be fine. Unfortunately, it didn't quite work out that way. It was a lot of issues with respect to the culture of the business, how we wanted to build, and it really did set us back, I would say, a couple of years just by having him be part of the organization. I look at the business we acquired. The reason why we were, you know, I say it set us back a few years is he was almost like a cancer to the business because we knew that he was, you know, he wasn't great with people. So we said, hey, you have a gift for sales, keep filling the pipeline. But any interaction that team members had with him, they came away with a negative experience. And it got to the point where we were just churning through people. And, you know, in this space, in the electrical space, finding talented and trained people, it's like finding unicorns.
Yeah.
So we were churning through talent, and that was a big driver as to why, well, one, we wanted to, you know, segment him off from any employee interactions. But also it is a reason why we did take, you know, an extra few years to get these things stabilized.
Well, it's also like, you know, in that space, the talent acquisition is the bottleneck. And
Yep.
and that's what holds your growth. So if you're churning, you're not growing.
Yes.
It's not a matter of like getting more clients, it's getting the talent. So
Exactly.
he was on the first deal, and then now you're going to buy the next deal. Did you have to kind of figure out an agreement to get him out of the entity before going to the next deal?
So we ended up just combining the two organizations, and we said, hey, you put up the down payment or part of the down payment for the next acquisition. We'll bring you on, and then we'll also refi your seller note into a bank note that the business is paid.
Sure.
So the seller note went away. The businesses started paying the bank note, which is one of the, that was one of the more attractive things. And so we said, yeah, come on in, 33%. Looking
Of the
back,
whole entity.
of
The whole.
everything.
Oh, wow.
So, and that was the driver once again was, hey, you're going to bring sales.
Yeah.
We're going to refinance your debt. And so the company pays the debt. So,
Yeah.
we're all third partners and the company's using EBITDA to pay the debt. Perfect. It makes a lot of sense. What once again, we did not take into account was the values and kind of the background of the person.
Yeah.
And so we now are very, we're very specific in terms of folks that we want to do business with, and it has to be the baseline has to be a shared set of values.
Makes sense. So that second deal, how large was it? What was the size, and then what was the
It was another small business, so it was right around 650K was the deal size, and just about 250 to 300 of EBITDA, which is what was advertised.
Got it. Okay, so like 2x, and then
Yeah.
so this time you did your due diligence.
To an extent. So as you'll see through the course of the story, it's really about, hey, we shouldn't be doing due diligence because of our rose-colored glasses. I think the business, in reality, this business was sound. It did what the seller said it did. And I joke about that part because what we did uncover was that we had several key team members that were being paid below market. And that's where some of the profit essentially was being generated from. But because we brought this other person in as a partner, it was within 6 months that we started to see churn from the acquired business to and also the organic company that we had. So that was the big cost. We still generated a little bit of profit from that business in year 3, but comparative to where we could have been, it was significantly lower.
And so at this stage, so 2020, so in 2020 you did only one transaction, right?
No, we did 3. So that was January of 2020.
Okay.
And then in May of 2020, as the world is shutting down, so hey, you know what? Let's be aggressive. So we bought our underground construction business. And then along with that, it was the same sellers. They wanted to also sell a fiber splicing company. So we bought both in the same kind of time frame. Yep.
They were split 2 separate entities.
Correct.
Got
Yep.
it. Got it. Okay. And what was the size of that deal?
So the total size between both companies was right about 2.3 million.
Okay.
We had a seller carry of, I want to say it was about $300,000.
Okay.
And we came to the table with about $300,000, $350,000, and then did a conventional financing for the rest.
Okay. So did you have to like refi the first deal? Or you just the first loan that you did into? No, it was a separate.
No,
So you kept
we
them
didn't.
separate. You kept the entities
Yeah,
separate.
we did, but we did have to cross collateralize. So
Okay.
because we were, we went with the same bank. The bank had been doing, we built a really good relationship with our banker. His name's Kalen Schwartz. So
Nice.
now at American National Bank. So that's a quick shout out. But he really helps us through kind of all of our transactions now. So one thing that I would give the listeners here is that build the relationship with your financing team, but also realize that if they're putting up roadblocks, it's not to, hinder the deal. It is because they're your only advocate in the deal.
Yeah.
The broker trying to sell the business has the deal in mind, and the seller. The seller really just cares about getting that check.
Yeah.
You have to have yourself really represented, and I think your bank, your attorney, your deal team does that for you. So just I've heard a lot of acquirers say that bank is giving me a lot of trouble. I can't deal with these people. Flip it on its head and realize that they want the best for you because that's how they get paid back. You're
Yes. Yeah, they're in the risk mitigation game, and you need as many eyes on the deal to highlight any risk that you may not have seen,
Yep.
and then adjust the terms within your deal to cover for that risk, 100%. So now, so end of 2020, you end up with a size what 3.5 million. Well, so, I'm sorry, let me go back. So the first deal was how much revenue by 2020? What's the revenue then?
So our electrical business was generating between $4 and $5 million of revenue
Okay,
with those combined entities.
okay,
And the underground construction business was about 2 million
okay,
in revenue. And the fiber splicing is about 4 to 500,000.
okay. So what about 7 million now? By the end of 2020, you're at
Six and a half. Yeah,
six and a
six and a half,
half,
7. Yep.
6.5, 7. Okay,
Um, well, I would say that the advertised revenue for underground construction was about 2 million.
okay,
What we actually got in 2020 was less, and I think a lot of that was the environment at the time. It was
makes
COVID.
sense. Chaos.
So there were projects that got kicked and things like that, but it was it was a cash flowing business, which was nice.
Okay. And so this is like one of the hardest things to do. Like you're just coming out of like the hole with a deal with a partner that's not the greatest. You buy one and then you have this churn culture clash and then you buy two more. How did you manage, now you have like two, at least two cultures, but three cultures in one
Yeah,
business. How
I'm a
did you
glutton for
manage all
punishment.
that? I know. Must be a
Oh,
masochist.
yeah, yeah. No, so the issue with culture from the other partner, we were starting to see that boil up more and more as we finished this acquisition. And we finished the acquisition and we thought, all right, well, we want to segment him off just to electrical. So I started managing the underground construction, the fiber splicing bit myself. So I was kind of the GM or the CEO of that line of business. Um, and at the same time, I still had my corporate job. So I still had my W-2,
Oh wow.
uh, and was working a, pretty pretty decent level, high level at the software company, doing consulting. It was a very difficult time. So I would get up after the close of the acquisition. I would get up 3:45, drive 2 hours away to try and understand what was going on. I didn't have a construction background. I have no idea what's going on. I probably lift a hammer, swing and miss. But so really try to understand the processes of that business. Hop in the truck, give a presentation to a consulting client for my W-2, and then try to understand what's going on with their business. And these are Fortune 50, Fortune 100 businesses. Then hop out of the truck and try to help understand a little bit more on what's going on. So it was a very difficult time. So like I said, it was waking up at 3:45, getting out there, and then coming home at 10:30, and then trying to do it all the next day. So definitely
Wow.
burning the candle at both ends. But what came out of that is that this was our fastest growing business.
Yeah.
And it still remains to be that way today because of the foundation that we've laid. So we went from, I think, year one, because it was COVID, we delivered something like $1.2 million of revenue. The next year, 2.2. The following year, 4. And then the following year after that, 5.6. And this year we should deliver right about 7.5 to $8 million just within that
No, one
division.
business. Wow.
Yep.
Um, so that must have been tough period. So how long did that, burning the candle on both ends last? How long did that period take?
It lasted about a year.
A year.
Um, yeah. And at this time, during that year time frame, my wife was also pregnant. We had our first kid. And I think back to this. We had our first kid, and 2 days later, I was back at work. So I
Wow.
reflect back on that a lot, and I think, there's a better way to do this. Obviously, taking the lessons learned for my next kiddo who was born, but man, it was definitely a tough time.
So how long did it take you to feel comfortable and you get your arms around that business?
It did take some time. So immediately I started hiring. I hired a project manager who helped do a lot of, get out on site a lot more. So that was, I want to say, 4 or 5 months in after I started to understand the business, started to get to know the people and build a rapport. Uh, I ended up quitting my W-2 about a year after we closed the acquisition. So April or so of 2021.
Okay. And then by then you feel comfortable. Now you feel
Yeah.
comfortable. You understand the business. You understand the drivers of the business. Now, remind us again, what is the business? Just so
So,
people understand.
so it is underground construction, meaning we take these really big horizontal drills, and we essentially drill underground, pull conduit, fiber, other utilities back under, and then ultimately do the hookups. So whether this is, and this can apply to any utility, whether it's power, water, fiber. Our specialty is fiber right now, but as I speak, we are actually going into other utilities as well, and you see that as the big green space.
Yeah. So
Um,
electrical is probably the fast growing segment now with the data centers and AI. And you and I have spoken about this. So that's the opportunity that's ahead.
Correct.
Yeah.
And
So in the
and that
right
is
place, the
the
right time.
that was the idea, right? We always thought about this of like, hey, let's get this peanut butter and chocolate mix of electrical, and we'll do all the underground in-house and we'll expand. Like anything, it takes twice as long and costs you twice as much to get from concept to ultimately implementation.
And between those two businesses, which is also something we talked about in the past, you have the underground construction and you have the splicing. And I remember the
Mhm.
splicing part had higher margin than the underground construction. But which one is your favorite? So, like, which part is your favorite?
I, I will say I do like the underground construction business. I have a bias there, right? Because I've been working on it for so many years. That being said, I can no longer call it just an underground construction business because we expanded this year to aerial. So now
Yeah.
we do everything on the poles as well as underground. So just very, very happy with how the team has embraced great company culture, with how they've embraced company values and how they've pushed for growth. So really,
And
really happy with that team.
so the beauty of these two businesses, and I think which is why it's difficult for you to say, okay, I like this one better than the other, is that they complement each other. They help each
That's
other. You know, I
correct.
mean, one feeds the other, and then one is profitable because of the other. So you can't
Yes.
just separate them and say, okay, well, how about like I just do this as opposed to that, but then you don't have this to generate that.
Right. And we are
Yeah.
trying to diversify. So we are trying to get, instead of everything being tied together, we're trying to have that splicing division go out to other, whether it's underground construction or aerial groups or other ISPs, and try to instead of just cross-selling services, go out there and make the sale itself. So I think
Yeah.
that is very promising for this year. And I think that, we hadn't paid much attention to this business. It started off at 400K to 500K in earnings, and this year is going to be our best year at maybe 800 to 900,000.
Wow.
But we are going to put the gas on it because we see the opportunity ahead, and we think that, hey, now that the others are stabilized, let's pour some gas on this one.
So you started in 18 with the first one. You get the next one or next three in 2020, right?
Glutton for punishment.
And then when did you get the next one? The next one, yeah, next one was the the trailer business, right?
Yeah,
And
yeah.
what year was
So
that?
this
21?
this was 22.
22.
So it started off with myself and Colin really trying to figure out how we can, you know, do things on our own versus having the culture that this other partner was putting in. So rather than really just push for him to be out of the business, we thought, well, let's just buy something else over here. It'll be the two of us. It'll be the start of our next platform. Anyway, the other partner got wind of it, was kind of emotional about it, and wanted to sell us his shares of the business. And so it was a great thing. It was, hey, we're getting two birds with one stone. So in 2022, we bought out that third partner. So it's now just myself and Colin.
Nice.
And we also bought this trailer manufacturing company. I think the closings were 2 days apart or 3 days apart.
Wow.
What we should have done is just had the adult conversation and said, hey, this isn't working as a partnership. Whether it's controlling personal spend through the business or just, developing a good company culture, it's just not there with this person. So let's part ways. Let's just, go through with the buyout. Because it was hard enough to go through and, get all of the things that he was doing, off his plate and get that stuff, kind of figured out, while at the same time dealing with the trailers acquisition.
Yeah.
So
that makes sense. That makes a lot of sense. So did you have someone else? So obviously you bought a few companies, so you had people with licenses within your new acquisitions that you would be able to leverage to get him out, if you will.
Yeah, and now we come at it from the perspective of, we need a master license, we can just go out to the marketplace and rent one. It's not something that is, at least not a showstopper. It's just the inexperience in the space, and then the emotional decisions that you make at the time that you reflect back and think, man, there was such a better way to do this. But we take those learnings with us into the next one.
Yeah. Okay. So tell us about the trailer manufacturer. I know you don't want to talk about it, but let's just one last time.
I'll say this is our biggest error. So the company was about $1.85 million, came with $1 million worth of real estate. So we thought, all right, we're hedged in terms of the downside. The business was $850, advertised for doing about $400K in EBITDA. So we thought, oh, great, this is fantastic. We met the seller. We thought, okay, we don't share the same values. This guy's kind of he seems very, the only word that's coming to mind is he seems like a scumbag. But, we don't have to live with this guy. We can fix the business, and this will be easy. Keep on coming back to this will be easy. Add on top of that, both he and the broker said that this guy is dying of cancer. We need to act fast. Like, okay, well, if he's dying, this is tugging at our heartstrings. He just wants to go and, be with his family. So we speed through the transaction. We speed through due diligence. It was a little bit tougher because he was running, a towing company, kind of a campsite, and this trailer manufacturing all out of one set of books. And so we were trying to pull data out of that to go through and validate the financials and validate what was on the tax returns. But, he gave us a lot of confidence with contracts that were signed, all of these different things. So great. We closed on the transaction. We admittedly did not go to the facility as much as we should have in the early days. So this is a facility that was about 2 hours away from our other operation that also required some of our attention. And, honestly, I just don't want to drive 2 hours to get somewhere. This is just a kind of a fault. So we ended up spending a little bit less time, but we did bring some of our electricians over to make sure that the shop, the manufacturing facility, was improved. So we did everything from upgrading services to making sure that people had quick disconnects, could basically connect to their welders and everything like that in a safe way, in a quick way. So we improved the facility. We built a paint booth, all those things. But when we dug into the numbers after the first few months, we realized that we were burning cash. And the contracts that this guy had signed, the trailers that he had sold, what he would do, and to show profitability, this is what he did. He would take a large deposit, deliver some, if any, of the product to the customer, and just count the deposit as revenue, right? So instead of it living on the balance sheet, he just said, hey, here's this. I'm robbing Peter to pay Paul, the base of any Ponzi scheme. So After digging in, we're like, we have to raise prices. We have to develop a different product set. We have to do all of these different things. So it took us a year to try and get that business, stood up properly. So we ended up having professional drawings made. We had, more design. We finally had costing systems, or at least some systems to develop to identify cost. Pushed out the dealer network, all of those things. But in that year, we had burned more than $1 million to try and get this thing. So the steepest of the steep J curve, and we were not paying attention to our other core business, right? It doesn't make sense in, reflecting back to really, to just fund our problems. We have this profitable set of construction businesses, and we have this unprofitable set of, this one trailer company, but we are spending our capacity, our time, energy, efforts, everything on this. So we decided, hey, we have to sell this thing. It doesn't fit the platform. It doesn't make sense for us to own a manufacturing facility and a construction business.
Yeah.
We fooled ourselves into thinking there was some sort of synergy. And the benefit is that the real estate appreciated. So we thought, okay, well, let's recoup what we can. We just have to stop the investment, because we're robbing our other businesses to invest in this. So we ended up selling the business for, 1.4 million was the real estate, $400,000 was the business itself, and the business was just the assets. We said, all right, the business is running at a loss. We're basically seeing the uptick of the J curve. Hey, this is on you, Mr. Buyer. You've got to focus on sales. But we've done a lot of the work in terms of getting this thing from, ground zero to one.
Yeah. And so you exit that business, did you break even, or what was, okay.
Yeah, we set about $1 million plus on fire.
On fire. So, okay. In about a year.
Yeah.
Okay.
That's the bigger cost.
Yeah.
So we lost so much time in terms of what we're trying to build.
Yeah.
So we're trying to build something special, just a business that has a great company culture, that has, it's not just about the money, but we're building something that every team member can have a great employee experience.
Yeah.
And it set us back years, both from that perspective, as well as, hey, what can we do for our next acquisition, or what can we do to grow organically?
Yeah.
So time was the biggest factor.
And your existing construction and electrical businesses were going through this transition where that partner is not there, and then your guys are instilling the new culture, new processes at the same time. And did they grow? Did they stay stable? What happened to that business during that time when you're dealing with this one?
So our underground construction company, it thrived. So it continued to push growth. It was great. Continued to deliver EBITDA to the bottom line. So that was fantastic. Our electrical business suffered, and it was continuing to suffer from the actions of that third partner. It takes a lot of time to turn the ship.
Yeah.
In addition to this, after we bought him out, we started digging into what he was doing. And unfortunately, there was a significant level of fraud there. So he would bury personal spend inside the business in project costs.
Wow.
He built himself a pool, hid the cement cost in one of our projects. He built himself a barn or a man cave or whatever, another structure, hid that into one of our projects. We were seeing profitability decline, and he was just embezzling a ton of money.
Wow.
And that comes back to the value side.
Yeah.
If somebody is willing to cheat or steal from the IRS, I get it. Nobody likes paying taxes, but just pay your taxes. Just play by the rules.
Yeah.
He's willing to steal from the IRS. He's willing to steal from you.
Yeah.
There's no gray line.
Yeah.
And then one other note. We also found out, so thinking about fraud, because of the trailer business, and I mentioned the other seller, he told us he had cancer in the stop story. We found it afterwards. It was all a lie. He didn't have cancer. It was just one of those things to get a couple of suckers to buy.
To buy fast and not look at anything. That's crazy.
Yep.
Dude, you guys have you're blessed. You have some good luck because one of the reasons why the underground business was doing so well during that period is because of the infrastructure money that was going. The Biden, what was that called? The
The
infrastructure act,
infrastructure bill.
the infrastructure
Yep.
bill. And
Yep.
so there was a big influx of capital into the system, which helps kind of lift that business while the other businesses, but man, it could have gone the other way pretty
You're right.
easily. And but yeah,
And
you guys are blessed.
we did tactically say, hey, third partner, you're going to be segmented away from this business. So
Yeah.
we kept him away from it.
Yes.
I was managing it. And
Yes.
so we limited the
Exposure.
cancer spread.
Yeah, the exposures to the cancer. Yeah, absolutely.
Yep.
Yeah, yeah. And I mean, it was a good business. Those are good businesses that you bought, and that's kind of
Mhm.
like good. And I've seen this trend where people like it's interesting. I've seen this trend many, many times with business buyers who do a bad deal at first, do another okay deal, and then they land a really good deal, and that really good deal kind of like makes everything work.
Right.
And then eventually they kind of figure it out, and so it's very common trend that happens. But without that first bad deal, you couldn't do the really good deal.
Correct.
And
Correct. We could have done without the bad,
yes, the very bad deal.
fifth deal.
Yes, yeah, the very bad deal. Yeah, that one you could have done without. Yeah, a little bit more due
Yep.
diligence and a little bit. But I think the theme around working with good people, buying from good people is
Correct.
so critical. It's so
Yes.
underrated. People think that they can fix things, but they don't understand that the business culture, the business soul, the business has that person in its DNA. Has
Yes.
the DNA of the founder in it. So if you take if the person is not an ethical person, it's not someone with good character, the foundation is going to have that in it. And
Correct.
so you almost have to, unless you're like him, you're not going to be able to run that business with your character. And
Right.
I mean, because you have to literally kind of gut the business from the roots and then start over.
And it is a bit of starting to believe your own legend, because the other
Yes.
businesses that we acquired, I mean, our underground construction company did not have the best culture, but we were able to turn it around. I'll give you an example. So this was a business that was run out of somebody's farm, and none of the team members had access to facilities. So if they had to use the restroom, um, they were told to go by the side of the barn. And
That's terrible.
that was the base of the culture. And there were so many stories of being short paid, or of, of course there were no benefits or anything like that for team members. We started to believe our own legend because we took that, we started to get it to grow. We got, everybody, the baseline for benefits, and now, what's deployed today is best in class. But thinking back to our trailers fiasco, it's, hey, we started to see the turnaround. Hey, we could do this. We started to believe our own legend, and that was a big mistake.
Well, that was, I remember that time you and I spoken, early that period when you were dealing with that manufacturing business, and I'm like the whole time, cut your losses, just yeah. But you had a loan on it, and that was kind of the reason why you couldn't completely walk away. You had to like do a transaction to, get rid of that debt, that liability.
And the saving grace, once again, is that the real estate appreciated.
Yeah.
That we didn't take a huge loss on the actual buy versus sell. We took a huge loss operating it to get it to a point where we could sell it.
So that's 21 to 22, right? So 22 you exited that.
23 is when we exited. 22 is when we bought the business. Yep.
You bought it in 22, you exited 23. And then 24 you bought something else.
Correct. We bought another electrical service business.
Okay.
And I think this is kind of our best acquisition from the perspective of what what we're now looking for. Took all the lessons learned from the other transactions and we applied it. The first thing is shared values and culture. We'll still go out and grab lunch with the old owners of the business. They're very ethical people, and they're just good people. Shared value sets. I think that is the most important baseline of what you have to look for when you're buying a business. Do you have a shared set of values with the person you're buying from? That is what made the transaction go super smooth. One, I mean, both Colin and I are not folks who have an eye for detail, so we kind of trusted, you know, our CPA, the attorney on our side. They also had the same kind of trust in their team, and we would have just like very open conversations about how we wanted things to look, what we want to do with the business, which is we want to maintain, we want to continue their traditions, and we want to reinvest into the business. And it wasn't just about, hey, this is about cash flow for me or, anything like that. It's maintaining and making sure that the guys are taken care of who work in the business. I think with that alignment of like culture, of values, it made everything so smooth. It is actually now, we've also started to deploy EOS and we've brought all of the businesses into kind of that one EOS umbrella. This electrical service business is now helping our organic electrical business try to develop some standards, try to develop, the right sales pipeline, things along those lines. So it's just been overall just a fantastic acquisition, a fantastic experience.
Wonderful. How big is that acquisition?
So the total price was, I want to say it was about 4.4 million.
Okay.
We actually used the SBA for this.
Nice.
And did a mix of SBA financing with a seller note. And we also acquired some real estate. So real estate was about 750K. The remaining portion was the business itself, and the business, like I said, the whole transaction was, it's created through debt.
What was the revenue?
Revenue was between 4 and 5 million over the last several years, and between 1 and 1.5 of EBITDA.
Nice. Okay,
Yep.
That's really good. So about 3.5 times EBITDA.
Yeah.
Okay,
But that's
really
including it's including real estate. So if you take
Including
the real estate out of
yeah,
it,
about
it's
3.
below 3.
Below 3. Okay, that's great. That's great deal, and it complements the original electrical business that you have. So now you kind of have three categories: that commercial electrical, you have the underground, and then you have the splicing. Correct?
Yep.
Got it. And then we're like how you and your partner kind of split the responsibilities.
So I've taken more of the kind of like the financial lead, the any sales lead. I'll take that. He'll take more of the operations. That kind of was the historical setup. Now, because we've deployed EOS, we've hired a great integrator. We have general managers for each of the divisions. We've stepped away from any of the day-to-day tasks, right? So I'm not in there getting phone calls about, hey, we have to pay this vendor or we have this particular issue. Well, no, that's going through the right channel and going through our integrator, whatever business challenge there is.
Yeah.
And we spend our time coaching our team members, coaching the leadership team. So we'll spend we'll go to one level 10 a month. We'll spend our planning sessions with the team and really set guidance around, hey, here's what we want to build. Here's the vision for the future of these businesses. Let's figure out how to get there together.
So are they now functioning as 3 separate units, or is it all one business?
It does have a shared service center, so it's kind of like the hub and smoke model.
Yeah.
So there's shared support when it comes to admin, when it comes to AP, AR, finance, legal, whatever. There's that shared hub, and then the 3 businesses, which are the initial electrical, the underground construction, and the fiber splicing. They're all housed in one building, so they have some additional shared cost or at least split costs there. And then the last acquisition is in a different location, but still has that shared support.
Got it. And so, but you're treating them, so like say, when you think about an L10, they're going to be, four different L10s, or are they going to be
No,
three L10s?
it's basically one
One,
L10. So
one.
we have the general managers from each of the divisions,
Okay.
as well as our integrator, and then our lead admin.
So how many general
So
managers? Four?
so it was four. We're now in the process of consolidating to one. So it's one representative for all of the electrical side, or one
Okay.
leader for all of the electrical side. We have one leader for the underground side, splicing,
Yeah.
admin, and then our integrator, and then
Oh,
myself and Colin
so
will.
technically you split it into two divisions with two general managers, and then your integrator acts like a COO.
Kind of. Yep. Yep.
Got it. Got it. Okay. Yeah, so that's interesting. I was trying to figure out. And then is there a sales division? Is there marketing? Where does that sit?
So that still falls under our admin side, but we are now moving towards an outsourced SDR. I'm running a little bit of an experiment as we speak of, hey, let's actually go through and deploy a CRM. Let's have an SDR go through and use, some AI tools, whether it's Apollo or something, generate lists. Let's start cold calling. We know where our greatest profitability is, right? Let's focus on partners that are going to generate that profitability.
Yeah.
So an example is, our underground construction company. The really great thing about fiber is that they're really long projects, and we can determine, our workload far ahead of time. The bad thing is it isn't as profitable as some of the other utilities. Right, you're drilling in fiber for, somewhere in that $10 a foot range. But if I look at things like supporting geothermal or supporting gas, solar, those expand the profitability marks, even though it's virtually the same work.
Yeah.
It expands the profitability significantly. So we're going to try to build on, hey, what are the most profitable areas that we can, and then go from there. So 10x is easier than 2x, right? We want to,
Yeah.
let's figure out what the 20% is, build on it, maybe not get rid of the 80%, but not grow it as much.
So you're so total across all the companies, what are you going to end the year at?
We're probably going to be right at about 17 million in revenue. We're going to be probably about 4 to 4.5 of EBITDA.
Nice.
I'd love to see us beat that stretch goal, but we'll see how August turns out.
Nice. And so you've done all this without any sales team.
It has been me.
Without a CRM. No CRM, no sales.
Yeah. So it's been me on the underground construction side. We had estimators on the electrical side. So that's the electrical side. The sales is basically on these big projects. You've got PM estimators. They're just going to get bids. They're going to figure out what the costs are, and they're going to submit it. A GC is going to then just pick the low bid.
Yeah.
But when it comes to things like home service, it is really about your name, your marketing, things like that, which is what our latest acquisition does bring to the table. So we want to continue to build on that.
So the latest one does both commercial and residential?
Yes, it does have it. Yes, it does have a service component. And instead of focusing on residential service, we really want to capture commercial clients. So just a place where, one example is we've got a customer who is, they're a industrial or they're a factory. They've got a ton of machinery that has electrical requirements. They'll call our team, or we'll have almost a dedicated resource for them to fix machinery. Because for them, if a machine goes down, it is lost revenue.
Yes.
So that's where we see the big potential in the near term. In the long term, I do feel like it is more about the infrastructure play and bringing these businesses together for that peanut butter and chocolate mix of how can we support the demand for, all of the power that is going to be needed for, AI and all these technology upgrades that we're getting in what seems like short order.
Yes, I know you and I talked about this. I want to kind of revisit a little bit. So, how do you see that evolution? obviously we're bringing a lot of manufacturing back in the US. There's a lot of reshoring that's happening. Manufacturers are going to want to expand to take advantage of, all this tariffs start hitting imported products so they can be more competitive and be able to produce more. And then you have the AI and data center. You have the data center on one side and you have the utilities on the other. What's your approach there? What is your kind of plan for the next, 1, 2, 3 years to kind of take advantage of that trend?
Yeah, I think it is definitely capturing the AI play. So it is, hey, you have all of these data centers being built that are going to support, all of our queries as you and I as consumers
Yeah.
are creating. But the build that's going to be required for this is going to be massive. And so the key is going to be building relationships with, the folks that, are transitioning from, maybe it was solar in the past, and now they're going to focus on delivering power to data centers. It's going to be building those relationships to say, hey, we have all of this stuff in one house. It's one place to go for getting pipe in the ground, getting it hooked up, and ultimately having power going to the data center. So that's going to be the value proposition, and we're really going to push here in the next year or so to break in to that space.
That's awesome. And do you have any plans for an exit?
No, not right now. I think for us, the goal is to continue to build something really special.
Nice.
It is to enable our team members to, gain more responsibility, to build their skill sets, to build their leadership ability. Us to be coaches, of course, and to try to help steer the business into what we see as the right, vision. But right now, it's hey, let's grow something special. Let's build something worthwhile.
So far you've been growing the talent pool through acquisition. And so how many people across all companies?
I would say it's a mix. So we are growing the talent pool by, acquisition as well as organically.
Okay.
So our I think at the height of the underground construction season, total across the businesses, we're about 90 team members or so.
Okay.
But when it's the winter, we shrink significantly because there is no outdoor construction in Minnesota.
Makes sense. Makes sense. So you go from 90 to what number? What's the lowest number?
It's probably around 45
Oh,
to
wow.
50.
Oh, you cut
Yeah.
it in
So
half. Wow.
yeah.
But it's incredible because I think I'm always finding it amazing because I've always been in warm places, but I know that, places that are cold like Michigan and Minnesota, they're used to that. There are periods where they expand and then there are periods where they shrink. And the population there is used to that as well. The workforce is used to it as well. So it's very
Exactly.
common. So
We
people
have
will,
team members that they love the lifestyle, right? I'm going to put in 50, 60 hours a week, maybe more, for 8 months out of the year, 9 months out of the year, and then I'm going to take 3 months off. I'm going to
yeah.
go ice fishing. I'm going to go, do whatever I want to recharge, and then hey, 3 months down the line, I'm gonna be back at it.
Or go to Jamaica.
There you go.
Yeah, nice. So within your company, did you build like a recruiting team? Is there like a funnel for finding talent and
Yeah, so we use outsourced services. So we
okay,
initially tried to bring this in-house. We were
okay,
less successful, but we have now found the right partner to help us with acquiring talent. So in the past, we'd just go with, hey, there's a recruiting or a staffing agency. We'll just give them a shot. Usually pretty terrible.
yeah,
Now we work with an organization. They charge us by the number of hours that they put in versus the percentage of salary of the person that they bring us. So
okay.
their goal is really not just to fill the seat, but to fill it with somebody who is going to outperform, because that's how we're going to go through and get the next person from them.
Got it.
It has been a really good model for
That
us
is
to have.
fascinating. I've never seen that model before. So they're charging you per hour spent on
Correct.
so essentially they're outsourcing their recruiters to you.
Perfect. Yep.
And then
Exactly
they're
right.
okay, and they're so it's an outsourced recruiter, and then is there like a you recoup some of that cost if the person is not the right fit, or no?
So far, we have not run into
Okay.
that issue.
Okay. So it's a
Every
straight.
person that we got from a staffing agency, they were not the right fit, and we've hired them. So that's like anything, it sets you back in time.
Yes.
This was, we've had several hires, and they've all been, and I'll knock on wood, they've all been outperformers so far.
Wonderful. And what are the roles that you're recruiting for?
So everything from, call it the leadership team to field staff. So we had a foreman recently, as an example. So a leadership in the field hired, and all of the feedback, now he's about a month in, all of the feedback has been so positive that he is
Nice.
removing roadblocks for the team, that he's helping execute, and ultimately driving the business forward. It's been fantastic.
Wonderful. And so okay, so and I agree with you. I think you have to test a lot of different ways, and even whether it is staffing or attempt to hire or some kind of hybrid model, you just have to, just like hiring anybody, you just have to go through a number of them before you find the one that's going to deliver the outcomes you're looking for. And then even in that case, they may good for a couple of years, and then it kind of like the performs may taper down, and you have to go find someone else. But you have to constantly be, and in your world, it's all about having the best talent, the most, the best talent on your team.
Yeah, and that's every business, right? It's the people with the best teams win, and so that's what we're trying to build, and build it around company culture, company values. I think that is the biggest takeaway that I had from my experience at Coupa Software, that company that went from $50 million valuation to a $20 billion valuation in 6 years. That company values actually matter.
Yeah.
I used to think of it as, oh, they're just words on a board. Nobody cares. But if you get everybody rowing in the right direction with those company values in mind, you are going to be a rocket ship.
Yeah, and I mean, it's not a esoteric concept. It's like it's a practical concept, because if you have people of the same value, then there's trust. Then people are going to trust each other, and then people are going to trust the leadership. And if there's trust there, and between each other, and they're aligned, so there's trust and there's alignment on where we're heading, then there's very little communication that needs to happen. It's very efficient communication that needs to happen, and then also communication is much easier. We can talk about what's not working. We can talk about what needs to be changed without doubting the intentions of the other person, and without, what I mean. So it's much less. We're spending less energy, solving these issues, and then moving forward. We're moving quicker. So it's and speed is the key. So the pace of movement is the key to how fast the money's going to come in. Your bottleneck is the speed of the lowest denominator.
Yeah, how fast you can grow, and with respect to the communication side has been helped out tremendously by deploying things like EOS. I'm a very big fan of that system now. We're about a year and a half into it. Still have a lot of room to grow, but that has been fantastic. And then once again, those company values, I think those two things in mind have really allowed us to stabilize, to grow, and to push for some new heights.
That's awesome. So as you're growing, moving forward, why are you not committing to going full force into building like a larger sales team that's going to be actively pursuing more growth? Or are you or you just love the acquisition through the acquisition game, so growing through acquisition and just buy the next one? It's a lot easier, it's a lot faster.
It is a blend, right? So we have those estimators who are bidding out different projects on all of the business lines, right? So that's just kind of the staple of construction.
Now,
as we continue to grow, we are going to have seats designed for, just relationship building.
Yeah.
As we had one earlier, that the person ultimately didn't stay with the organization. They weren't the right fit, so we had to counsel them out. But we can once we define the right person, once we define that, we'll be able to fill that seat. We'll be able to continue to push that relationship building and ultimately concentrate on those projects that are more profitable.
Yeah.
When our PM estimators are really focused on just getting estimates out the door, all that is a race to the bottom. We want to build relationships and show here's the value that our companies bring. It's
Yeah.
not just about the lowest dollar amount, because
Yeah.
there are so many other value added services that we bring to the table that others aren't going to provide.
Yeah, yeah, it makes sense because it's nuanced. It get missed by the people on the other side, especially when you're dealing with either large companies or government entities, or almost like
Yes.
semi-governmental entities, where
Yep.
they're just going for the lowest price. It makes a lot of sense. Do you have any acquisitions in the pipeline now?
So we've talked to a few different organizations, and we don't have any LOIs out or anything like that, but I would love for us to complete a transaction in 2026.
Nice.
But we'll see how it goes.
Nice. Okay. Well, I appreciate it, Chandra. I know we've done this a few times. I'll love to hear your updates and see how the company has grown. You guys have done an amazing job, and I'm always rooting for you guys. So
Thank you, my
hopefully
friend.
we'll see you in a year or so to hear more updates.
Excellent. Thank
Thank
you
you.
again. Thanks for
Thank you.
having me.
Have a good one. Thank you.
Cheers, bud.
Bye.